Hi students, welcome to Sunil's tutorial. I'm Sunil Nirwani and today we'll be doing capital budgeting. Let's see this. I'm doing question number 2, page 281. Right? They have given you that the investment is 1 lakh, time estimated life is 10 years. They haven't given you the scrap value. So first thing that you have to do is calculate depreciation. Depreciation is nothing but original cost minus scrap upon estimated life. Cost of the asset is given to you as 1 lakh. Scrap value is nil. Upon estimated life is given to you as 10 years. So depreciation is going to be 10,000 rupees. Once you have the depreciation, then you can calculate. They've given you profit year 1, 2, 3, 4. They've given you profit before tax, they've given you tax. So you can find out profit after tax. Profit after depreciation is given to you as 30,000 and tax is 15,000. So profit after tax will be nothing but 30,000 minus 15,000. Then similarly for the second year it will be 50,000 minus 25,000. 40,000 minus 20,000 and 40,000 minus 20,000. Right? Once you have profit after tax, you add depreciation back to it. Depreciation is 10,000. Depreciation is 10,000. Profit after tax plus depreciation is going to give you cash inflow. So if you add this is going to be 25,000, this is 35,000, this is 30,000 and this is 30,000. Right? I have cash inflow. Once you have cash inflow, then you find out your cumulative cash inflow. Or you can make a separate table. You have your cash inflow, then you will make another table. Years 0, 1, 2, 3, 4 cash inflow. Now at present point of time you have purchased an asset of 1 lakh rupees. So there is not a cash inflow but you have a cash outflow of 1 lakh rupees. You don't have cash inflow but you have cash outflow, and your cash inflows are 25,000, 35,000, 30,000 and 30,000. Right? So you can now find out your cumulative cash inflow. How do you do this? Write this figure here as it is 1 lakh negative. 1 lakh plus 25,000 is 75,000 negative. Write it adjoining in the adjoining column. 75,000 plus 30,000 is going to be 40,000 negative. Right? 40,000 negative plus 30,000 is 10,000 negative. 10,000 negative plus 30,000 is 20,000 positive. Right? As soon as you get your positive figure, you stop calculating your cumulative cash inflow. Right? In this case, how do I find out payback period? Payback period, you will have payback period those many years so long as you have negative cash inflow. Your negative cash inflow is till the 3rd year, so your payback period will be 3 years plus multiply the final negative cash, cumulative cash inflow by 12, multiply the final cumulative cash inflow by 12 and divided by the adjoining cash inflow. Right? So this is going to be 3 years, 4 months. So payback period is 3 years, 4 months. Question: why did I calculate using this formula? Because actually the formula for payback period is original investment upon annual cash inflow. The reason why I did this was because the cash inflow is different in different year. When the cash inflow is different for different years, then you have to calculate the payback period by this method. Let's see another sum, guys. I will do question 3, page 82. Question 3, page 282. Year 1, 2, 3, 4, 5. Right? Cash inflow. We will write this from the 0th year so that we don't have to make two tables. Cash inflow is given to you. They give you the net cash outlay for a investment project of 30,000. So you have a project of 30,000. Since you are spending that money is going to be negative. You have a cash inflow of 9,000, 12,000, 8,000, 4,000 and 5,000. Right? Once you have your cash inflow, let's find out cumulative cash inflow. Right? You start with your 30,000 negative. 30,000 negative plus 9,000 is 21,000 negative. 21,000 negative plus 12,000 is 9,000 negative. 9,000 negative plus 8,000 is 1,000 negative. 1,000 negative plus 4,000 is 3,000 positive. As soon as your cumulative cash inflow becomes positive, you stop. Right? In that case, your payback period, you will take those many years where you have negative cash inflow. The last negative cash inflow is the complete number of years that you will take. So this will be 3 years plus whatever is your last negative cumulative cash inflow, last negative cumulative cash inflow, multiply that by 12 and divide it by the adjoining cash inflow. That's 4,000. This is 3 years and this is going to be 3 years, 3 months. So payback period is 3 years, 3 months. Fine. Let's see another sum of this kind, guys. Illustration 10, page 287. Right? Let's see this. They've given you that cost of the project is 5,20,000, estimated life is 5 years, and scrap value is 20,000. So the first thing that you have to do is calculate depreciation. Depreciation is nothing but cost minus scrap upon estimated life. Cost of the project is 5,20,000. Scrap value is given to you as 20,000 divided by life of the project is 5 years. So this is going to be 5 lakh divided by 5. So this is going to be 1 lakh. So depreciation is going to be 1 lakh rupees. They have given you years 0, 1, 2, 3, 4, 5. Right? They have given you the PAT. They have given you your profit after tax. Your profit after tax is given to you as 30,000, 50,000, 70,000, 90,000 and 1,10,000. Right? Profit after tax, add depreciation. Depreciation is 1 lakh. We've already calculated. It is going to be same for all the years. 1 lakh, 1 lakh, 1 lakh, and 1 lakh. right? Profit after tax plus depreciation gives you cash inflow. So this is going to be 1,30,000. This is 1,50,000. This is 1,70,000. This is 1,90,000. This is 2,10,000. Right? Now, you have purchased the machinery for 5,20,000. So your initial investment is going to be 5,20,000. Since money is going out, this figure is going to be negative. Now, you find your cumulative cash inflow. So this is 5,20,000 negative plus 130, 520, 420, 390. This is going to be 390 negative, 390 plus 150, negative 390, 290, 240, 240 negative, 240 and negative plus 170, 70,000 negative, 70,000 negative plus 190, 120 positive. As soon as you get positive figure, you stop, right? So your payback period is going to be the total number of years for which cumulative cash inflow was negative. The final year in which the cumulative cash inflow was negative is 3 years, plus multiply the negative cash inflow by 12 and divided by the adjoining positive cash inflow. That's 1,90,000. So when you do this, you will get your answer as 3.368 years. So your payback period is 3.368 years, right? Just check that calculation, people. Fine, right? 3.368 years. Right? Check that calculation, people. Is that coming to 3.36? 3 years plus this is 3 years plus, someone tell me how much is this? 70,000 into 12 divided by 1,90,000. .368. No, how much is it coming? 4.42 months. I gave you the answer in terms of years, you are giving me the answer in terms of months. So it's 3 years, 4.42 months. So either you can write 3.36 years or you can write 3 years, 4.42 months. Right? Do you get this? We will stop this here for the day. Thank you very much.